Good morning, everyone, and welcome to our webinar for October 2024. We begin as usual in America, where the Federal Reserve Bank, through its Monetary Policy Committee, has cut interest rates by 50 basis points or 0.5%. Some economists have been saying that the Fed is behind the curve, and they say that they've kept rates too high for too long in America, and that the result of that will be that the US will go into a recession. Jerome Powell, who's the governor of the Reserve Bank, denies this, but of course it is a real concern. In the latest MPC meeting, 11 of the 12 members voted to cut interest rates by 50 basis points, which shows that that decision was almost unanimous. And notably, the 12th member wanted to cut by 75 basis points. So there is some concern in the MPC that rates have been too high for too long. Of course, it all depends on the labor market. Job creation has dropped from about 155,000 jobs per month in 2023 to current levels around 96,000 jobs per month being created. But of course, that still looks pretty good. I mean, that's still nearly 100,000 jobs a month that are being created. That doesn't look like an economy that's heading into a recession. The unemployment rate was slightly up at 4.4%. And the Reserve Bank has been engaging in quantitative tightening. That means that they are selling bonds out into the marketplace, and they're reducing the money supply by about $60 billion a month, to also reduce the size of the Reserve Bank's balance sheet. Inflation in the August month came in at 2.2%, which was much better than expected, and is now very close to the Fed's target of 2%. Investors were expecting another 50 basis point cut in November, but we think that's quite unlikely. At the same time, China has cut interest rates aggressively and has increased borrowing limits in order to stimulate their economy, which has been a bit in the doldrums recently. The combination of that plus the prospect of a possible another 50 basis point cut in interest rates has pushed the S&P 500 to a new high. If you look on your screen there, you'll see the S&P chart. We predicted this in our tweet on the 14th of August, which is over here. We predicted that the S&P would break to new record highs, and there you see it at new record highs. Originally, before this 8.5% correction, we gave a tweeted warning that there would be a correction. We did that on the 10th of July when the index was at 5633. And then it fell all the way down 8.5% to a cycle low here at 5186 on the 5th of August before beginning a very sharp upward move. You'll notice that this move had 8 consecutive days up, right? That is very unusual on Wall Street, and whenever you see something like that, you can be pretty sure that the next day it will go down, which of course is what it did. Then we entered a period of consolidation, and I believe profit taking, in other words, people who'd bought a little bit earlier, possibly in this cycle low here, decided to take profits and get out, and then the market continued its upward trend, and now we're sitting at a place where we're getting more new record highs, and once again I think there's been a bit of profit taking last night. Wall Street came off a bit, and that could be more profit taking. All right, so the S&P 500 is going up strongly, and that is dragging other markets up with it. This obviously confirms that the bull trend is still in place, the bull trend which began in March 2009. It is, of course, important to understand that the S&P is dominated now by NVIDIA, the AI company. In fact, in the last quarter, NVIDIA has accounted for about a quarter of the S&P's rise this year. NVIDIA itself has gone up about 140% so far this year. It is impacting the S&P 500 both positively and negatively. It's basically making it a bit more volatile. When NVIDIA goes up, the S&P 500 goes up, and vice versa. That can be seen from what happened during the trading day on the 11th of September, when Nvidia rose by 8.2% in a single day, and that pushed the S&P 500 up 1%. The prospects of artificial intelligence are already heavily discounted into the market, and they are pushing the S&P higher and higher to new records. All right, so that's the markets. We are, of course, looking at the final stages of the presidential election with Harris and Trump. The evidence is that Harris is leading in the popular vote, but everything, of course, comes down to the electoral colleges, especially in the swing states. The result will not have a major immediate impact on markets, in my opinion, but it will have a longer-term impact. Both candidates will almost certainly increase government spending and, of course, therefore, the government deficit in America. Over the past 25 years, it has become politically impossible to reduce that deficit. Cutting the deficit would, of course, cause a prolonged recession, which would be unpopular and therefore politically unacceptable. But, of course, eventually the piper must be paid. The US cannot continue indefinitely overspending and borrowing in order to create prosperity. We believe that a moment of truth is still, however, some distance away. The markets, including the JSE, will therefore continue to follow Wall Street up to new record highs, and that is what has been happening. We'll talk more about that just now. All right, let's turn our attention now to what is happening in Europe. Ukraine still occupies part of Kursk, the Kursk province in Russia, despite the Russian efforts to get them out. Its new F-16 fighters are now preventing Russia from using glide bombs to the same extent. Russia has, of course, made some small advances in the Donbass, but at enormous cost, and we see that Putin is now proposing his sixth conscription of troops. He's looking to raise a further 133,000 troops, which I believe means that the number of troops raised through conscription since the war in Ukraine began is now around about 1 million people. And there are some 600,000 of those who have been killed or injured in the Ukraine war. So this has become quite a big thing. What is apparent to us is that the Ukrainian drone technology is moving ahead of the Russian drone technology. That's what we seem to be seeing. They seem to have dominance in the air, especially around Kursk. We've seen them move a large number of vehicles and troops into the Kursk region without any real air response or drone response from Russia. So they seem to be able to now attack targets inside Russia with virtual impunity. Russian air defenses have been shown to be mostly incapable of stopping them. The most dramatic example of that, of course, was a week or so ago with the destruction of the ammunition depots around Taiva. The explosion from the first of these attacks was so large that it was visible from space and registered 2.8 on the Richter scale, the earthquake scale. To us, it looks like the Russian army is in a shambles. It does not look like it can maintain the pressure on Ukraine for much longer. Russia has avoided US sanctions and Western sanctions by working through China and India. It's been trading with them, but now the ruble seems to be collapsing against both the Chinese yuan and the Indian rupee. To us, Putin appears now to be hanging on by his fingernails. His only real hope is that Trump wins the US elections in about a month's time. He faces rising pressure from the oligarchs inside Russia and the populace, and the body count, which is rising by about 1,000 to 1,200 people killed or injured every day, is not helping. We think that there's a strong possibility that Russia will make an attack on a US military base before the elections. They will use a conventional weapon, we think, and they will make sure it's a base outside of America, in other words, one of their foreign bases. And the point of doing that would be to enable Trump to say that he's the only person who can avoid World War III. It will give him a fantastic boost to his election prospects, we think. He will say that because of his relationship with Putin and obviously now with Zelensky, he is the only one who can stop World War III. And I think some Americans will be convinced to vote for him on that basis. And that is a bit of a scary thought. So for the next 33 days, we will have a bit of a risk there, or next 33 days. So we will be basically on some kind of a knife edge now. In our view, Putin knows already that he is losing power in Russia, and he may well be desperate enough to risk attacking an American military base. If I'm wrong, and this does not happen before the election, and Harris wins, then all of this goes away. But we think that if Harris wins, it probably signals the end of both Putin and Trump. So we are on a bit of a knife edge for the next month. Obviously, if Putin is gone, and so is Trump, then I think equity markets around the world, including the JSE, will benefit enormously. Okay, let's turn our attention to the local economy. The Government of National Unity is now a vital element of South Africa's economic future. And, of course, the shares which are listed on the Johannesburg Stock Exchange. Policy differences still exist between the ANC and the DA, of course, especially on the Basic Education Act and also on the National Health Insurance Bill. Ramaphosa says he is engaging with Steenhuisen, the leader of the DA, to resolve both of these differences. We believe that the GNU, the Government of National Unity, will survive these problems. In the economy, things are looking a little bit better. Inflation slowed to 4.4% in August from July's 4.6%, and it's now below the midpoint of the target range. And it's got there much more quickly than anybody expected, including the Reserve Bank itself. The Monetary Policy Committee cut interest rates by 25 basis points in September, as expected. They should bring rates down by a further 75 basis points, perhaps even before year-end. The move, of course, was half of what the US cut their interest rates by, and that will make our bonds more attractive to overseas investors. Lower rates, plus the lower price of petrol, will boost consumer spending and growth. The producer price index fell sharply to 2.8% from July's figure of 4.2%, mainly because of lower fuel costs. The AA says that 95 octane will fall by a further R1.13, and of course, as we heard the other day, it has in fact fallen by R1.16 per litre. And 93 on the Highveld here is down by just over a rand, 106 I think. The Bureau for Food and Agriculture keeps track of the cost of food for an average family of 4 in South Africa. In July month, that cost was 3,761 Rand for the month. These are obviously, the minimum amount that a family of 4 could spend. And that number of 3,761 Rand for the month is up 4% from a year ago. This shows that the official inflation rate of 4.6% is not unrealistic, or 4.4%. The price of chicken is a major part of this. Chicken is a primary source of protein for South Africans, especially poorer South Africans. Whole chickens have gone up 19% since 2021, but quick frozen chicken pieces are down 12% from what they were a year ago. The chicken business, of course, is a very tough business with huge stocks and massive semi-skilled workforces and so on. So it has huge working capital considerations. And of course, they are subject to the various types of avian flu and bird flu that force them to kill off large populations of chickens from time to time. So the price of chicken is critical in this country. And we have had avian flu this year, so that has pushed the price up a little bit. The Reserve Bank says that gross domestic product growth will only be about 0.6% in the third and fourth quarters of this year. But next year, they say that growth will rise to 1.6%, and that's in 2025. We are expecting it to be at 2% or maybe even higher in 2025. So we think that their estimate is conservative. The Reserve Bank's quarterly bulletin shows that government debt increased by 8.4 billion rand in the second quarter, mainly due to lower tax revenues from both mining and agriculture. This government debt, is expected to reach about 75.3% of gross domestic product in the 2025-26 year. And that means that about 21.3% of all the taxes collected will go just to pay the interest on that debt. That's more than 1 rand in 5 of what is collected in tax is going to go just on interest. So South Africa is very close to what is known as the debt trap, where it has to basically borrow in order to pay the interest on its existing borrowings. That thing can get out of control, and we can end up in a very difficult situation. Hopefully, the Government of National Unity will be able to pull us back from the edge of that abyss. The Treasury says it will achieve February's budget projections, but we are not so sure. The midterm budget policy statement, of course, is due on the 30th of October, at the end of this month, so we will know soon enough. Fitch, the international ratings agency, has maintained our status at BB-, which is, of course, below investment grade, with a stable outlook. They see the economy growing 1.5% next year, which we again think is conservative. They draw attention to the fragility of the new Government of National Unity, especially as far as the national health insurance issue is concerned. Ramaphosa seems to be very concerned about problems within the GNU and determined to iron them out. He is negotiating with the DA to find solutions. GDP growth was 0.4% in the second quarter, up from the minus 0.1% in the first quarter, so that's positive. The end of load shedding was, of course, a big help, and optimism, of course, over the GNU has had a big impact too. We see second quarter growth as a turning point. We think it will be the lowest point. And we think from here on growth will be rising. In the decade before the Government of National Unity came into power, international investors took 700 billion out of South African share market and about $1 trillion rand out of South African bonds. So we've had a huge outflow of funds. Foreign direct investment has been pathetic. Since the GNU came into power, the flow has reversed, and our bonds and shares are now seen as cheap. The Bank of America projects that our shares will go up about 17% in the next year or so, and that our bonds are about 13% undervalued. Manufacturing production rose 1.7% in July, after a decline of 5.5% in June. Food and beverages were up 9.5%. Metals and machinery were up 5.2%. BankServe's take-home pay index was up 6.7%, so the average South African took home 16,582 rand in August month, and that's well above what it was. It's 6.7% above what it was in August last year. Inflation, of course, was down to 4.4%, so consumers are much better off than they were last year. Also, of course, the cut in interest rates will save people with a bond of, say, 2.5 million, nearly 500 rand a month. With the drop in the petrol prices, we should now expect consumers to start spending. BankServe's Betty Index, which measures transactions in the South African economy, was also up. The next major problem in South Africa is likely to be water shedding. Bankrupt municipalities have not been paying for their water. They owe the water boards about 21.3 billion rand, which is making it very difficult to do maintenance of the water system. This is resulting in the collapse of water infrastructure, and parts of Johannesburg are already experiencing water shedding. So that is another major problem that is looming on the horizon. The civil service unions are demanding a 13% increase in their pay and a 2,500 rand a month housing allowance. This will, of course, make it very difficult for our Finance Minister Enoch Godongwana to keep the government wage bill under 700 billion, and that may become a problem for the Government of National Unity. Investec is already warning that tax collections in this period will be about 80 billion below target. The bond market is rising, of course, because of optimism over the Government of National Unity. The yield on the 2035 bond is just over 9%, which is, of course, much higher than the 3.8% that you can get from a US Treasury bill. The GNU has reduced the perceived risk of investing in South Africa, making it more attractive. The rising gold price has resulted in a trade surplus in South Africa, benefiting the current account, and the current account deficit has dropped to 0.9% of GDP from 1.5% at the end of the second quarter. Gold exports were up 34% as the dollar price of gold surged. The cost of electricity is, of course, a major problem for both consumers and businesses in South Africa. Those that can afford it have installed solar power, but many people cannot afford it, especially poorer people. The National Energy Regulator of South Africa has increased the price of electricity by 12.4% in the 2024-25 year, and Eskom is asking for a further 30% in the 2025-26 year. Over the last, since 2008, electricity has risen by 945%. So 2008 was the year when load shedding began, and over that whole period it's gone up by nearly 1,000%. South Africa is now one of the most expensive countries in the world for electricity. Many small businesses have had to cut staff or have disappeared completely as a result. In this country, we are supposed to be giving 50 kilowatts of power free to about 10 million poor people, but in reality only about 2 million are getting this benefit, mainly because of inefficiencies at Eskom and in the municipalities. Remember that Eskom just got a 254 billion rand bailout from the Treasury. This means that Eskom has been and is very heavily subsidized by the South African taxpayer. The South African economy is moving rapidly towards online shopping and physical deliveries. In 2023, e-commerce was 6% of total retail, and that's expected to rise to about 10% by 2026. And this has meant that there's been a rise in organized hijacking of motorcycle deliveries as a result. I suppose that's predictable in South Africa. In 2023, there were an average of 20 incidents per day, and that's now risen to about 50 in August of 2024. The police force seems to be powerless to curtail crime syndicates operating in South Africa. And of course, this will push up the cost of e-commerce. The Road Accident Fund is bankrupt. It's got debt of 23.9 billion rand. They also received an adverse opinion from the Auditor General in their most recent audit. In the 2022-23 year, they made a loss of 8.4 billion rand, massive legal costs, and many payouts, especially to foreigners. For example, in 2023, they paid a Swiss billionaire 500,000 rand for his claim. And now, 450 million rand is owed just to Belgian nationals. Obviously, these are tourists who came to this country, had a road accident, and they're putting in a claim. Altogether, the fund owes foreigners about 1.5 billion rand. The Road Accident Fund is becoming a major problem because it constantly runs at a loss every year. All right, in a recent survey, only 5% of South Africans saw climate change as a major problem. But of course, the flooding in Natal recently and the closure of the N3 due to excessively high snowfalls in the Van Rieenen area shows that climate change is beginning to impact on South Africa. In our view, the climate is going to become a major part of share assessment. 2023 was the hottest average temperature throughout the world for that year, and 2024 is hotter. So climate change is becoming a reality very rapidly. All right, let us turn our attention to the rand. I just want to find the chart here. That is not the chart. That is the chart. There it is. Right, so the rand is directly, of course, impacted by two factors, two most important factors. And just want to put a bit more data on the screen here so that you can see this better. There we are. Those two factors are obviously the local developments, things that happen here in South Africa on the political and economic front, events like the GNU, the Government of National Unity. And then on the international front, we are impacted directly by the attitude of international investors towards investment risk. They are either risk on or they're risk off. When they are risk on, they sell the rand. When they're risk off, they buy it. Over the past 16 months, basically since this peak in the chart over here, the rand has been benefiting from an improving local situation. And of course, the end of load shedding has helped, the advent of the GNU has helped, and all of those things have made South Africa look much more attractive as an investor, as an investment. At the same time, there's been a strong bull trend on Wall Street, and obviously therefore a massive shift towards risk on. International investors, of course, regard the rand as the best of the emerging market currencies because it is a very free market with quite a large volume trading through it every day. It gets about 50 billion rand going through that market each day, the rand market. After its low of 1975, which is here, which happened on the 25th of May 2023, since then the rand has been strengthening steadily. On Wednesday last week, it broke actually to a high here of 17 rand and 2 cents to the US dollar. We see this trend is continuing. We see the rand breaking to 16 rand to the dollar in due course and even below that level. This is very good for South Africa. It boosts confidence in the local economy, and of course it reduces inflation by making petrol cheaper and cheaper. Right now everything is very positive for the South African economy and the rand. A while back we did draw your attention to this triangle which you see on the screen, and we said at that time that the rand would continue in the direction that it broke out of the triangle. A triangle is a period of reducing uncertainty, and you can see that because the rand fluctuated from that low level, that strong level there, to this weak level, back to the strong level. But you'll notice that this strong level was not as strong as that level. And then it went back up, found this trend line again, back down again, back up. But all the fluctuations are getting smaller and smaller. And eventually, a triangle is always broken one way or the other. And it tends to continue in the direction in which it is broken. So here, you've got a perfect example of that. And you can see now that we've broken below this cycle low at 1775, which is also very important. All right, let's look at some commodities now. I want to start off by looking at platinum group metals. Let's put the platinum chart on the screen for you to look at. The production of platinum group metals in South Africa has been declining. I think actually that's good enough. So there you can see there you can see COVID-19 on the edge of the screen. That's March 2020. Platinum went up very strongly after that, but since then it has been declining steadily. The production of platinum in South Africa has been declining by about 1.7% since 2006, mainly due to falling prices. Many mining shafts have now been closed because they were unprofitable. The industry has been retrenching staff left, right and center. About 10,000 employees have lost their jobs, or about 6% of the platinum group metals workforce. Implats has cut 4,000 jobs, Amplats 3,700, Sibanye 2,600. Production is expected to continue declining, even though demand now exceeds supply. Production of platinum group metals is now lower than it was during COVID. The South African government is, of course, dependent on the tax revenue from PGM, from platinum group mining. but the spread of electric vehicles has curtailed the demand for auto catalysts and is expected to continue doing that. Amplats fell out of the JSE Top 40 index on the 20th of September. It was replaced, by the way, by Pepcore. And Anglo is trying to get rid of its platinum group mining altogether. So there you can see the chart. Coal is also looking pretty miserable. The coal price has collapsed from about $450 a ton in 2022 to current prices around $113 per ton. Despite this, electricity prices from Eskom have been going up. As I said earlier, the Eskom has just had a 12.4% increase in the price of electricity. This seems unaccountable given that the price of coal, which is its primary source of energy, has been cut to about a third of what it was in 2022. And of course this combines with the problems of Transnet and the restructuring, and it's caused a lot of restructuring in the coal industry. Seriti, which runs 6 coal mines, mainly to supply Eskom, is now retrenching 1,240 workers. Glencore is in the process of reducing its exposure to the coal industry in South Africa, and they wrote down the value of their coal assets by $660 million in their interim results recently. All right, let's look at gold. Gold is a better story than that. Gold, of course, was a very important metal in South Africa. At one stage in 1970, we produced 1,000 tons of gold. It's hard to believe now. Last year, we produced less than 100 tons, so we've dropped to less than 10% of what we produced in 1970. That, of course, is mainly because the gold reef is now very deep, making it very expensive to access. Economically viable reserves of gold in South Africa are almost exhausted. The situation has been made worse by union action and, of course, the cost of electricity. But the US dollar price of gold is now going up, as you can see from the chart. Now, we drew this to your attention a little while ago. We drew your attention to the fact that gold had broken up through this resistance level at 2,060. We did that in March 2024, so about 6 months ago. And since then, the gold price has just gone through the roof. You can see the strong upward trend. In fact, it's gone up by about 28% in that period of time. Over the same period, gold in rands has only gone up 14.5%, and that's because the rand has been strengthening. Obviously, a stronger rand is not good for the gold industry because they get paid out in a foreign currency. So lower gold production also meant that South Africa did not benefit very much from this move. We expect the gold price to continue going up in US dollars, especially now that interest rates are falling in that country. Of course, when interest rates fall, they make things like US Treasury bills less attractive. And people go to US Treasury bills because they want security. Gold, of course, offers zero return. So you can get 3.8% on your US T-bills, but you can get nothing on your gold. It doesn't add 10% to its weight. It doesn't pay rates. It doesn't pay interest. It doesn't pay dividends. So gold, the only reason you hold gold is because you want security. And it competes with the US T-bill, which offers 3.8% per annum. So as interest rates come down in America, gold becomes more attractive and US T-bills become less attractive. Okay, the last commodity I want to just look at here is oil. So I'm just going to go to the North Sea Brent price of oil, which is quite an important chart. You can see here the chart. The Brent had a floor there at about $72 a barrel. I think I prefer the other one. Just bring in a bit more data here. Just want to show you here, this is where Russia invaded Ukraine, right? So that's back in March of 2022. It caused the oil price to spike. And then Joe Biden went to visit Saudi Arabia in June of 2022. And after he was there, the oil price has been tracking down ever since. And it seems to have found a floor here at about $72 a barrel. There was a cycle high in April this year at 91.60 and a cycle low there at 77. But that downward trend is now resumed. And you can see here that we look like we may be even breaking below the $72 a barrel support level. Obviously, a falling oil price is very good for America. I mean, it reduces the price of petrol, it reduces the price of petrol worldwide, and it cuts inflation worldwide. So it's very good for shares and for economic growth. It's also good for Kamala Harris in her bid for the presidency, and bad therefore for Trump. And it's terrible for Putin, because Russia is a major exporter of oil. So it cuts the cash that he's got available to finance his war in Ukraine. Anyway, we are looking at a declining oil price, and I'm sure that Biden made some arrangement with the Saudi Arabians to keep oil down until after this election. All right, let's go to looking at the JSE and the companies. I'd like to just begin by looking at the JSE overall index, because that has been rising to new record highs, as you would expect. Okay, that's too much. There you go. You can see here that the index made a low there at 63,264 on the 29th of September, and it's been rising. It's been an upward trend since then. You can see that trend is supported by a couple of touch points here in October last year, and now again in March, April this year. The previous high of 80791, which was made on the 27th of January, has now been broken quite decisively, and the index, you'll see how the index comes back, finds that previous support level, that previous resistance level, which now becomes a support level, and then it's bounced off that and gone up very, very strongly. So the effect of a rising overall index is that, of course, it means that there are more and more shares getting onto the winning shares list. In fact, at the close of trade last Friday, there were 118 shares on the winning shares list, and 116 of them were above the prices at which they were added onto the list. Only one share was below, and that share was Bidvest, which was down a mere 1.53%. The best share on the winning shares list was Core, which was up 265% since it was added to the list in 136 days. The second best share was Steph Stock, which was up 214% in 99 days. So the winning shares list is going crazy because we're in a bull trend. The JSE is obviously going up, and the two best sectors are property and banking, so I just want to spend a little bit of time on that. Property shares on the JSE have been very cheap for a long, long time. But here is the JSE property index. It's called the SAPY, S-A-P-Y, all right? And I'd just like to just show you this. You can see there's the cycle low, and we're now in a very strong upward trend. But most JSE shares, property shares, have been in the past trading well below their net asset values. Now that interest rates have begun falling, they are going up strongly. The FNB Commercial Property Broker Survey for the second quarter shows a sharp improvement, with 44% of respondents saying that conditions were satisfactory. That's up from 30% in the first quarter of this year. And the property index is going up very well. So we expect this trend in property to continue going up, and we've been drawing your attention to it for quite a long time, to the fact that property shares were trading well below their net asset values. All right, the banking index is another one which is worth looking at, and that's probably the second sector that is really benefiting from the upward move in since the GNU was sorry, I just want to get this chart right, came into force. Okay, so what you see here is that the banking index made a low here in March, obviously because of 2020, because of COVID, and that it then recovered very rapidly until about March of 2022, so for 2 years. Then it spent 2 years going sideways. And here you can see where the government of national unity came into power, and you can see the dramatic impact that's had on banking shares since then. And again, we drew this to your attention on quite a few occasions in our confidential reports in the past. But banking in South Africa has changed dramatically in the past few years. most people now have a bank account, have a digital bank account. More than 20 million people in South Africa have a digital account and very seldom visit a branch of their bank. So that is a big change. In the 6 months to the 30th of June, the 4 big banks saw their credit loss ratios decline on average substantially. This is because of improved credit management, mainly through data mining. So now the banks are taking advantage of the digital situation to understand their customers much better at a digital level. And that means that they can obviously give their loans more effectively, and they've got a lower credit loss ratio. Operating profits amongst those big banks rose by 5%, and net profits were up 2.5%. And that was during a time when interest rates were very, very high. They've only just started coming down. Now that rates are falling, we expect the banks to make even better profits. So look at this chart and think about whether you should be in the banking sector. All right, the first share that I want to look at is Hyprop. Hyprop is, of course, a real estate investment trust. It owns some of South Africa's best-known shopping malls like Rosebank, Hyde Park, Clearwater, and so forth. It's got a loan-to-value of 36.4%, plus a strong cash position of 803 million rand in the bank. So it's very solid from a balance sheet point of view, very, very low risk. And we added it to the winning shares list, as you can see over here. Just want to put a bit more space on that chart. We added to the winning shares list over here on the 15th of August at 34.39, 3,439 cents a share. And it closed on Friday at 45.40, right? So it's gone up very nicely. It's gone up about 33% in just 6 weeks. We expect it to continue performing well. The next share that I want to talk about is Outsurance. Outsurance, of course, took over the listing from Rand Merchant Bank on the 7th of December 2022. This was after Rand Merchant Bank had unbundled all its other assets like Discovery, Momet, Momentum, Hastings, and so forth. In the results for the year to the 30th of June, Outsurance reported earnings up 20.3%. They paid a special dividend of 40 cents per share, which is what caused this big jump in the share price here. It caused the share price, in fact, to jump 17% in a single day. But we already had it on the winning shares list back here. So it's gone up about 32% in the 106 days since we put it onto the winning shares list. So that's quite a nice return. It's up there at about 58 Rand a share now. All right, York is a company that produces wood products mainly for the construction industry. In their recent, just still looking at that. Okay, here's the York chart. Got to put more data on the screen. Now, York is interesting because a while back it was a very popular share and got a lot of traction. But then it did this incredible head and shoulders formation here that you see. And that happened in 2021, 2022. And then, of course, it began a long downward trend. We suggested to you at the time that you should wait until it broke up through this downward trend line, which happened over here on the 30th of... that happened just there. Let me just pick up that date. I want to pick up that date. There it is on the 22nd of April this year. It was about 165 cents when it broke up, and it's gone up to about 240 cents now. So it's doing quite well. Of course, it's quite volatile. In a trading statement which they just produced on the 30th of June, they said headline earnings per share would come in at between 28.2 and 36 cents. That compares with last year when they made a loss of about 76 cents. So this share is volatile. Its earnings are volatile, and there's some risk here. But it is one of the shares that will probably benefit substantially from the government of national unity because of the surge in construction companies and construction projects that are taking place. All right, Burstone. Burstone used to be called Investec Property Fund. It's a real estate investment trust. It owns about 4.7 billion rands worth of properties in South Africa, Australia, and also in Western Europe. Only about 35% of its assets are inside South Africa, so it's clearly a rand hedge. The group is working to reduce its loan to value to 33.5%, which means it's very solid financially. It expects disposable income of around 50 cents. That's distributable income going to shareholders, around 50 cents for the 6 months to the 30th of September 2024. If you look at the chart, you can see we added it to the winning shares list over here at 809 cents. And it has since moved up to the close last night, which is 963 cents. So it's gone up quite nicely, about 18% in just over a month. CA Sales has been on the winning shares list for a long time, more than a year. It's one of those shares that's been on for a long time. We originally added to the winning shares list over here in September, I think it was the 25th of September 2023, and at that time it was 775 cents, and it closed last night at 1500 cents. So it's gone up about 93.5%, nearly doubled in just over a year. This is a company that's involved in warehousing, distribution, marketing, and point-of-sale systems. So it's quite a good company. We expect it to continue going up. It's one of the relatively new listings on the JSE, and obviously the big institutions are now getting involved. Okay, folks, that's about all I have for you today. I hope that you found some of this useful, and please listen to our broadcast next month on the first Wednesday of November, and I will be back with you. Thank you for listening to me.